I'm 58 years old now, and looking back, my perspective on money has shifted dramatically. When I was younger, it was all about chasing the highest returns, the next big thing, the stock that was going to explode. But with a few decades of experience under my belt, I've learned a hard lesson. Protecting what you have is often more important than chasing what you don't. Did you know that if you lose 50% of your investment, you need a 100% gain just to get back to where you started? That single statistic changed everything for me. It's a mathematical reality that highlights the brutal power of losses. If you're serious about changing how you think about money, I highly recommend a book that really helped me rewire my brain. It's called Money Rewired: How to Think, Grow, and Live Rich No Matter Where You Start. I've left a link for it in the description below. It's a fantastic read that really gets to the core of this mindset shift. So, what exactly is capital preservation? It's simply the strategy of preventing your investment principal, the money you started with, from losing value. It's about playing defense. Think of it like this. In football, a great offense might win you games, but a solid defense wins championships. Your financial journey is a championship run, not just a single game. This doesn't mean you should stuff all your money under a mattress. Far from it. It means being strategic and a little more conservative, especially as you get older or when the market feels uncertain. When I was in my 20s and 30s, I had a long time horizon. If the market crashed, I knew I had decades to recover. But now, at 58, my timeline is different. A major loss would be much harder to bounce back from before I need that money for retirement. This is why my focus has moved from aggressive growth to smart, sustainable preservation. Let's get practical. How can you start applying this? The first, and maybe most important, step is diversification. You've heard it a million times. Don't put all your eggs in one basket, but what does that really mean? It means spreading your money across different types of assets. So, you might have some stocks for growth, but you'll also have bonds, which tend to be more stable. When stocks go down, bonds often hold their value or even go up, acting as a cushion for your portfolio. For someone just starting out, a simple way to diversify is through low-cost index funds or ETFs. Instead of picking individual stocks, you're buying a small piece of the entire market. For example, an S&P 500 index fund gives you exposure to 500 of the largest U.S. companies. It's diversification built right in. The second step is asset allocation. This sounds complicated, but it's just deciding what percentage of your money goes into each type of asset. A common rule of thumb used to be the 100 minus your age rule. You'd subtract your age from 100, and that's the percentage you should have in stocks. So, a 30-year-old would have 70% in stocks. At my age, under that old rule, it would be about 40% in stocks. But today, with people living longer, some financial advisors suggest using 110 or even 120 as your starting number. The key is to find an allocation that lets you sleep at night. If watching your portfolio drop by 10% makes you want to sell everything, you're probably too aggressive. Your risk tolerance is personal. It's about what you can emotionally handle without making rash decisions, and that's the core of capital preservation, avoiding panic selling at the worst possible time. A third practical tip is to focus on quality, instead of chasing speculative, high-risk meme stocks. Look for established companies with a long history of profitability and paying dividends. These are often called blue-chip stocks. They might not double in a year, but they are also less likely to go to zero. They are the steady workhorses of your portfolio. Dividends are especially powerful because they provide you with a regular cash flow, which you can reinvest to buy more shares or use as income. It's a way to get a return without having to sell your assets. Let us talk about a specific strategy that is incredibly accessible for beginners and aligns perfectly with capital preservation: dollar cost averaging. This is where you invest a fixed amount of money at regular intervals, say $100 every month, regardless of what the market is doing. When prices are high, your $100 buys fewer shares. When prices are low, your $100 buys more shares. Over time, this approach averages out your purchase price and reduces the risk of investing a large sum of money right before a market dip. It takes the emotion and guesswork out of timing the market, which is something even the pros are terrible at. This is a disciplined approach that builds wealth steadily and helps you avoid emotional mistakes. I've learned that patience is the ultimate superpower in investing. The desire for quick, massive returns is a trap. It leads to taking unnecessary risks and often results in significant losses. building wealth is a marathon, not a sprint. The goal isn't to get rich overnight, it's to build a secure financial future. Brick, by prioritizing capital preservation. You're building a strong foundation that can withstand market storms. You're reinsuring that the money you work so hard to save is there for you when you need it. Think about it. What good is aiming for a 20% return if you're risking a 50% loss? I'd much rather aim for a steady, reliable 7 or 8% with much lower risk. That's the kind of math that leads to long-term success. It might not be as exciting, but trust me, financial security is a lot more satisfying than the thrill of a gamble. So, I'm curious to hear from you. Have you ever experienced a big loss that changed your perspective on investing? Or are you just starting and trying to figure out your own strategy? Let me know your thoughts and questions in the comments. I read them all and try to respond. It helps me understand what you're going through. If you found this helpful and want to continue the conversation about building a solid financial future, please consider giving this video a like and subscribing to the channel. It really helps us reach more people. Thanks for watching, and I'll see you in the next one.